Okay, family. We're going through a life insurance practice test, and so you can reinforce the information so we can all go ahead and pass the state exam on the first try. All right, Jess, take us away.
Okay, a policy owner takes a policy loan from a whole life policy. If the policy loan plus interest exceeds the cash value and the insurance dies, what happened to the death benefit?
You gotta read the question.
Did you hear me?
Yeah.
Oh.
Read the choices too.
Okay, so A, the insurer pays the full face amount. B, the insurer deducts the loan balance from the death benefit. C, the policy is void and no benefits are paid. Or D, the insurer pays only the cash value.
What you think?
It's not C.
You're right about that.
And it's not B.
Why do you think it's not B?
The insurer deducts the loan balance from the death benefit.
If the policy loan plus interest exceeds the cash value and the insured dies, what happens to the death benefit?
I thought it was A.
I mean, it's in the question.
Let me help you. The answer is B, and I can see how it could confuse you because they just put some extra stuff in there. It says, now you know what the way whole life insurance works. If you borrow the cash value and you die, they're gonna subtract it from the face amount. I mean, that's like easy peasy. But the way they put the word of this question, if the policy loan exceeds the cash value and the insured dies, like it really don't matter if the policy loan plus interest exceeds the cash value, that don't have nothing to do with nothing. Whatever is the outstanding loan, they're gonna subtract it from the death benefit, and that's what the beneficiary gonna get. So the answer is B.
Okay.
All right. So sometimes on the test they have extra stuff that'll throw you off because you be trying to figure out how that works. So just stick to word association. Whole life, loan, is they're gonna subtract it from the death benefit. They go together every time.
Okay.
All right, Tay.
Under the life insurance replacement regulations, which of the following is not required from the replacing agent? Signed statement from the applicant acknowledging replacement, comparison of existing and proposed policy benefits, notification to the existing insurer within 30 days, immediate surrender of the existing policy. Is not required. C.
No, the answer is D.
Immediate not required.
Right. Let's say if a person let's say if we offer them a policy with us and they already got a policy with whoever, and we're replacing that policy. When we do the application with us, we don't want them to cancel their other policy until the new one is issued.
Right.
So that's why, so the answer is we do not want them. It's not required. Don't cancel your existing policy until your new one is issued. So that was a tricky one. That one was a harder one. But all that other stuff, signed statement from the applicant, comparison of existing policy, notification of the existing insurer, that ain't really nothing that you, the agent, got to even do or keep up with. The company does that. So that's why there was a tricky question because you don't even do that. All you do is the application and everything you put on the application, the insurance company uses that to do all that other stuff. The only thing you need to know is when you're replacing a policy, they don't cancel the other policy. Got it?
Yep.
All right, Kendrick. Kendrick, if you're talking, you're on mute.
For some reason, it won't let me get it off, but I'm on there now.
All right, talk to me.
Number 3, which of the following policies allows the insured to adjust mortality charges, interest rates, and expenses periodically? A, universal life. B, adjustable life. C, variable life. D, whole life. So I know it ain't D, whole life. But if I was to choose, I would have chose B, adjustable life.
No, the answer is A. So the reason why why do you know it's not D?
Because the whole life is not going to change.
Right, it's fixed premium, fixed death benefit. Why do you know it's not C? The key word in C is variable. If you see variable, the answer gonna have something to do with the stock market, cash value invested in mutual funds, that kind of stuff. So it don't have nothing to do with that. C ain't got nothing to do with what the question is asking. B is adjustable life. Now that could be tricky because adjustable life, you can adjust it, but what you adjust on an adjustable life is the premium period or the coverage period or the type of plan. Like it'll change from whole life to term, or it'll change from a 20-pay life to something else or whatever. So you ain't even got, they ain't even gonna ask you all that on the test. But what they're asking you in this question about mortality charges, interest rate, expenses, that is universal life insurance. The mortality charge is when, what we tell people to look for is flexible premium. Mortality charges is the premium. That's the flexible premium. What you're paying for the death benefit is the premium. It's just worded differently. Got it?
Got it.
All right. Jess, back to you.
In the modified endowment contract, MEC withdrawals are taxed based on A, FIFO first in, first out, B, LIFO last in, first out, C, tax-free distribution, or D, only principal is taxable. I'm gonna go with C.
The answer is B. Ooh,
Okay, can you explain that one?
I got a good test for y'all tonight. All right. So you see right there where it says first in, first out, or last in, first out. So let's say when you put money into an insurance policy, the insurance company or the IRS wants you to pay taxes on the earnings. You follow me? The taxes get paid on the earnings, not the premium you paid. So if you got last in, first out. So let's say if you put in $50 a month, right? $50 a month for a year is $600. Well, the earnings by the end of the year is, or the tax, or the interest by the, and let's say if it's 10% you make on it, $600 a year, 10% of 600 is $60. So the interest you got paid on the end is more than the $50 a month that you started with in the beginning. Does that make sense?
Yeah.
Because if you just putting in $50 a month, and at the end of the year you put in $600, 10% of that is $60. Where the interest on the front is less than the interest on the back because there's more money on the back. And the IRS is trying to get you to pay more taxes. So they taxing you on what you put in last. So last in, meaning the last amount of money you paid, first out, meaning we're going to tax you on the money you taking out.
Okay, got you.
So that's kind of tricky. You just got to come up with a
A way to remember it.
Your way to remember it. You ain't got to know why. You ain't got to try to remember all the why, but that's why. They trying to, the more taxes you're going to have to pay.
Okay.
And the main thing you got most of the time on this test, when you see modified endowment contract,
Uh-huh.
You just typically, those questions with that are gonna be related to somebody raising money or has an expensive premium. Typically, that's gonna be the question and the answer. If you see modified endowment contract, there's some kind of way they buying a policy to raise money, and they don't mind paying more than the typical policy. The first letter in E is endowment. The first letter in expensive is E too. So that's how you can catch it. Got it?
Yes.
I'll tell you next.
Which non-forfeiture option provides coverage for the longest period of time? Reduced paid up insurance, extended term insurance, automatic premium loan, or cash surrender? Is it B?
No. Oh, no, no, no. Yeah, no, no. You're right. No, the answer is not B. It's not B, and the answer is A. And let's discuss.
That's crazy.
Let's talk about it. The question says, which non-forfeiture option gives you the coverage for the longest period? Got it?
Yeah.
Longest period, like longest period of time. So from 30 years old to 100 years old or whenever you die, could be 40 years later. Got it? The
Mhm.
longest period. Got it?
Yeah.
Letter A, reduced paid up. How long does a paid up policy cover you for?
Um, until you die.
Until you die. Paid up for your whole life. Paid up mean you ain't gotta pay no more. You cover for the rest of your life. That's the definition of paid up. So that's technically an easy one. When they said longest period, when you saw paid up, boom, that's that. Because I'm gonna get you have that for the rest of your life.
Okay.
And when it said extended term, term, the key word is temporary. So if the question
Mm,
says which one have the longest period,
yeah.
then you know it ain't term because term is
Right.
temporary. So yeah, you got to make that connection with paid up is permanent rest of your life with the longest period. That goes together.
Okay. Okay.
Now, now let's say if they had reworded this question and said, which non-forfeiture option provides the most coverage?
Mm-hmm.
Or it could say the most coverage, period, or it could say the most coverage for a temporary period. Either way, most coverage. Then the answer would be B.
Okay.
B, extended term, gives you the same amount of coverage you had before on the policy. So that
Right.
gives you more. Reduced paid up gives you less coverage for the rest of your life. So you got to make some notes, put that together. Extended term is most coverage for life. Reduced paid up is less coverage. No, extended term is most coverage for temporary period. Reduced paid up is less coverage for life. So when you see it, you can get it. All right, Kimber.
Question number 6. Which of the following riders would not increase the death benefit? A, cost of living rider. B, accidental death benefit rider. C, waiver of premium rider. D, return of premium rider. So the first one, I would pick A because I don't think the cost of living would increase the death benefit.
Mm-mm.
Mm. Accidental
Yes.
death.
Hey,
Uh,
y'all wanna guess? Jess, you wanna try?
is it D?
It's not A. I think it's B.
Nope.
So then it would be the common sense because it said would not increase. It would have to be the waiver.
Yep. The answer is C.
And it's in the question. It says would not increase. If it's a waiver, that means it is gonna waive whatever. So it's not gonna move, right?
Yeah, that's half right.
Something. Well, that's just a way to remember it. Is the way.
Yeah.
Well, that's how the
Yeah,
question
yeah,
is.
yeah. You have right because you said you exactly right when you say
Right.
waive, meaning you don't have to pay. and it's waiver
Mm,
of premium. Waiver of premium is a disability rider. If you become disabled, they waive your premium. You ain't got to pay no more. So, that ain't got nothing to do with giving you more death benefit, a higher death benefit. So when you say waive, I just want you to know what you're waiving. You're waiving the premium because you're disabled. Got it?
I
Because
got you. I got you.
you might see that question again.
I got you.
Cost of living, whenever you see cost of living rider, cost of living goes with inflation. Inflation means stuff costs more. So a cost of living rider would give you more coverage to keep your policy, to keep up with inflation. That's why it's increasing your
Mm,
death benefit.
I see. I see now.
And accidental death rider is a multiplier anyway. So if you die, they're
Right.
gonna pay you 2 or 3 times the death benefit. And return of premium rider is gonna pay you the death benefit plus give you your money back. So that would increase your death benefit too. If you guys, and I'm gonna send y'all this recording, you watch this video over and over, create you some flashcards and just get these words down and make it so much easier. Because all these concepts are simple. You just got to be able to put it together. Ain't nothing hard about it. You ain't got to calculate nothing. You just got to remember cost of living goes with inflation, gonna increase the policy. You just got to know accidental death is a multiplier. It gives you a multiple of the death benefit. You got to know waiver of premium waives the premium if you're disabled. That does not increase the death benefit. All right. Jess.
An insured dies during the grace period without paying a premium. What would the insured do? A, deny the claim entirely. B, pay the death benefit minus the overdue premium. C, pay the full death benefit. Or D, pay only the cash value. So I feel that it's not A or B, and I think it's C.
So is
Then
it is
why do you think it's not B?
Mm,
Well, first, Rebecca, you tell me how does the grace period work? Because it's a grace period question.
um, it's like something days.
the grace period like 30, 31 days, is it not?
That's exactly right. And what
Mhm.
happens? What is grace period?
It's the grace period is the period of time that the insured has before, was it like their policy lapses or something?
That's exactly right. You right. It's the 30 or 31 days to pay the premium or your policy gonna lapse. So let's say if your policy is due,
So it's B,
B.
it's B, right? They gonna pay
because
if
they
your
gonna pay, but they gonna subtract the money that you didn't pay.
Okay, so pretty much, I have a question. So pretty much what you do is you read the question and you look what the question is asking for. So what the question was really asking for is if you know what grace period is, then what you would do is take the definition and use the definition within the question and re-ask yourself the question and give you the answer, right?
all day. It worked every time, all day, all day. All right. Uh, number 8.
Which of the following statements?
Trying to make it bigger.
Mm.
All right, I leave it.
Which of the following statements regarding convertible term insurance is true? Conversion requires proof of insurability. Premiums for the new policy are based on original age. Conversion must occur within the term period. Cash value is transferred to the new policy. Which of the following statements is true? Without proof. Is it B?
No.
Does occur within a term period? Cash. Term insurance.
Is it C?
Yeah. Why is it C?
Because the term doesn't have a cash value policy, so it can't be D. It doesn't require proof of insurability.
That's
And
right.
and with term, the premium is going to be the age that you are.
That's right. Gonna be attained age. That's exactly right. So the answer is C. And conversion means you have a term policy, and conversion is term to perm. Renewal is term to term, conversion is term to perm. So if you're converting your policy, you're converting it from a term policy to a whole life or a permanent policy. And you gotta do it while the policy is in force. You can't wait till it lapses and convert it. So the answer is C. If you got a 30-year term, you gotta convert it before the 30 years is up. Does that make sense?
Yeah.
Yeah, so yeah, that was a simple one. I mean, it could be complicated, but you just got to convert it before the term is up. It's really serious. So you got to do it within the term period. And all them other ones, you need to know that because that would be, and that could possibly be in another question. You need to know conversion does not require proof of insurability. And premiums are based on your attained age. Just the age you are when you are converting it. And the whole term don't have no term don't have cash value. All right, let's go. Kendrick, you up, number 9.
Number 9, which of the following is true regarding policy dividends on a participating policy? A, they are taxable as income. B, they are a guaranteed return of premium. C, they are not guaranteed and considered a return of overpaid premiums. D, they must be paid annually. Participating policy.
Don't let that participating policy part throw you
Yeah,
off. Just
that's
stop right
yeah,
there. They
that's
got dividends. Any policy that pay dividends is called a participating policy. So don't let that throw you off. If the policy pays dividend, it's called participating, meaning you're participating in the profits of the company in theory. But yeah, don't worry about that part. The policy paid dividends. What happens with the dividend?
that's gonna be A
No.
or it's C.
Yep, it's C.
I knew it. I should have said C first.
Dividends are not taxable. All right. Dividend, you might see this on the test. Dividends are not taxable, but the interest on the dividend is taxable. The dividend is not taxable, but the interest on the dividend is taxable. You got to know that interest is taxable. Whenever you see that, that's on any of this.
Yeah, because it always made me think about the stock market, but you can't think about it like that.
No. The interest is stock market is too complicated, but the interest is just going to be taxable. Let's keep it simple. Interest is taxable. Just put that together. Interest taxable every time. But
Interesting.
on this test right here, dividends are not, or this question, dividends are not guaranteed and they're considered a return on overpaid premium. All right, Jess.
If an insurer becomes insolvent, which entity in most states guarantees payment of policy benefits up to certain limits? A, the FDIC, B, the NAIC, C, the State Life and Health Guarantee
Yep, guarantee.
Association, and D, the Insurance Commissioner. C?
Boom, let's go. Give me a high five.
High five. Bow.
Bam. That's it. The State Life and Health Guarantee Association guarantees your policies if insurance companies go out of business.
I think I had a question like this on my test.
On the test too, it may ask you can't use in theory, you're not supposed to use that to get the person to buy the policy. That might be on the test too. Like the insurance, I don't know why they want to keep it a secret or something, but the State Life and Health Guarantee Association can't be used to induce or influence them to get the policy. So if a client
Oh
says,
yeah.
what happens if the policy, if y'all go out of business? You can't say, don't worry about us going out of business because the state gonna pay the premium, gonna pay your death benefit. You can't say that.
Right.
All right, Tay, pick us up right there, number 11.
A survivorship life policy pays the death benefit at the death of the first insured only if both insureds die within 10 years at the death of the last insured when the policy matures at age 100. Is it C?
Yeah, man, y'all on fire. Look at that. 2 in a row. Survivorship is the second to die, the last insured. The answer is C, yes. If it said joint and survivor, joint is first to die, and survivor pays when the second one dies. Got it. All day. Great job. All right, Kendrick, next.
Which of the following is true about variable life insurance? A, cash values are guaranteed. B, premiums are flexible. C, death benefit may increase or decrease depending on investment performance. D, investment risk is borne by the insurer. True about variable life insurance. I'm gonna say B.
You would be correct, sir.
Now, when they say
We just talked about this earlier, but let's go back up here to question 3. You remember I said you got to remember universal is flexible. Adjustable, you got to pay, you can change the payment period or coverage period. And what did I say about variable life?
Stock market.
Stock market, yes. Whenever
That's
you
how I
see the
remember
word,
it. I ain't gonna lie.
yeah, whenever you see the word variable, is invested in the stock market, is investments, is not guaranteed. So down here, number 12, the answer says death benefit may increase or decrease depending on what?
investment performance,
Investment performance. Bro, that's an easy one. As soon as you read that, you should have been like, bam, next.
variable investment. I got you.
Variable, investment, stock market, not guaranteed, how they go together. They just, sometimes, the English language got 10 different ways to say the same thing. And we got to know the different variations. All right. Tay. No, Jess.
An insured commits suicide 1 year after the policy is issued. The insurer must A, pay the full death benefit, B, pay the cash value only, C, refund all premiums, pay, or D, deny the claim without refund. A.
Okay, no, no. No. Read that one more time.
An insurer commits suicide 1 year after the policy is issued. The insurer must A, pay the full death benefit, B, pay the cash value only, C, refund all premiums paid, or D, deny the claim without refund. C.
There you go. C.
C.
Why is it C?
I remember saying this in class and she explained it.
It's super, super easy. When I tell you the answer, you're gonna be like, dang, got it.
Okay, what is it?
It's the 2 years, the waiting period is 2 years. So the same question that said he committed suicide after 2 years, they'd have paid the death benefit. But they committed
Okay, so
suicide within
after 2 years is full death benefit. After 1 year is refund.
after 2 years is full death benefit, and any time, any period less than 2 years is refund of premium. You got it's called a standard exclusion, meaning the company ain't gonna, I don't care who it is, the company not gonna pay within 2 years if you die, if you kill yourself, there was fraud on the application, they're not gonna pay if you die within 2 years and there's some shenanigans on there.
Okay.
All right, like a war, suicide, I think it's one
Okay,
more.
so I just got the answer question. I got the answers mixed up.
Yeah. All right. Yeah, but you just got to know 2 year period, waiting period on suicide and war.
Okay.
Okay. 14.
Which of the following statements about group life insurance conversion is correct? No evidence of insurability is required. Conversion must be to a term policy. The insured has 60 days to convert. Premiums remain the same as group rates. I want to say A.
Let's go.
Damn, that's it. Don't second guess yourself. The answer is A all day. You know, some people say read all the answers and all the questions, and it may be a bad habit I got, but I don't. I promise you, I don't. Soon as I see the one that I know is right, I pick it. I don't even read the rest of them because I don't want it to give. I don't want to read it and then I start second guessing myself. Well, oh, that sounds right.
And I
Nope.
said A off rip too.
And as soon as you said, as soon as I read that, bam, A next. I wouldn't even have read the rest of the choices because I know A is right. Once you see the answer that your gut feeling is right, pick it. All right. Next, Kendrick.
Which provision prevents the insurer from denying a claim after a specific period due to misstatements, except fraud? A, grace period. B, incontestability clause. C, reinstatement clause. And D, entire contract provision. Would it be B, incontestability clause?
Yes, bam, the incontestability clause, meaning after, and once again, it says specific period, but the answer is 2 years. 2 years. That same question could have had, instead of saying after a specific period, it could have said 2 years. Got it?
Got it.
All right. 16.
The waiver of cost of insurance rider is most likely found in which policy type? A, whole life. B, variable life. C, universal life. Or D, term life. A.
No. The answer is
C.
the answer is C. But this could be a tricky one right here because waiver of cost of insurance rider. Waiver of cost of insurance rider. What? I don't know whether they just trying to be difficult just because they ain't got nothing else to do. But waiver of premium is if you become disabled, you don't have to pay your premium no more.
Right.
Waiver of cost of insurance rider, it must be the same thing, but it's just specific to universal life. Universal life insurance has two components, the insurance and the premium and the cash value. The insurance premium part is the cost of insurance goes up inside the policy. Why they would change the name from waiver of premium to waiver of cost of insurance, I have no idea. But that's basically where this is headed.
Okay.
The only reason this was tricky, I would have got it right just because I know cost of insurance goes with universal life, but typically that's not, they don't even really explain it like that on the test or in the class. All right. Tay.
If a life insurance policy is classified as a modified endowment contract, what happens to policy loans? A, they become taxable as ordinary income. B, they are tax-free. Can you scroll down? They are taxed only if the insured dies. They reduce the face amount dollar for dollar. Go back up real quick. I want to say to policy loans. Is it on A?
Yeah, but it's A. How did you know it was A?
I feel like I've seen it before.
Okay, you're a good guesser.
No, that ain't what I said.
MEC loans are taxable as ordinary income when taken. So let's say with an MEC contract, people use it as an investment and not a death benefit. So if the cash value exceeds the premiums paid, then you pay taxes on that loan, on the money you took out. So that's kind of technical. But on the test, like I said, most of the time, if you just see the word endowment, you mean it's expensive and you got to pay taxes. In fact, this question is kind of related to the question we had earlier when it asked about is tax on what basis, and the answer was last in, first out, LIFO. And this is saying basically it's still a tax question. All right, Kendra.
Which of the following annuity payout options provides the highest monthly income to the annuitant? A, life income. B, life with period certain. C, joint and survivor. D, refund life. Is it A?
Hey, yes, sir. You got it right. Why is it A?
I remember saying something about life income, and I just be honest with you, I just guessed on it.
You got the good guess award too.
Isn't life because you get paid until you die?
Big check, no Benny. You ever heard of that? Big check, no
Yep,
Benny?
that's it.
Big check, no Benny. The life income option gives you the biggest check with no beneficiary. So it pays one person, the one person the rest of their life. But it's no beneficiary. It doesn't pay your spouse. There's no money left to whoever your beneficiary is. So it pays the highest monthly income. So you just got to remember life income, big check, no Benny. Highest check, no beneficiary. So on that question, it says, which of the following annuity payout option provides the highest monthly income? That same question could have said, which one pays the highest monthly income and nothing to the beneficiary at the death of the annuitant? And the answer still would have been A. Got it?
Got it.
All right. Come on, last two. We're going to get these dadgummit. Come on, Jess. Let's finish strong.
Which of the following is not considered a type of dividend option? A, paid up addition. B, 1 year term insurance. C, cash refund. Or D, accumulate at interest. C.
Bam, girl, look at you on fire. That's what I'm talking about. The answer is C, cash refund. Which one of the reason why, and that's kind of tricky too, and you picked it out fast
Well, we
because,
was over here talking about it, and
okay,
then
well,
like cash refund was just something that just it didn't look right as an answer.
well,
The
what's crazy is out of the dividend options, cash is one of them, but it's just not cash refund.
Right.
So if it had just had cash without refund, the answer wouldn't have been C. So the acronym for a dividend option is CARFO or CRAPO. Cash, reduced, paid up, accumulated interest, paid up, addition, 1-year term. So those are the 5. So which every one of these is not one of them is the answer. And they had cash refund. They trying to be tricky on here. All right, Tay. This is it, bro. That's the game-winning shot. Come on, man. We down by 1. We got 4 seconds left on the clock. You wide open at the free throw line. Come on.
All right. An insurance producer's license may be revoked for all of the following except misrepresentation, rebating, obtaining a client's written consent for replacement, commingling funds. I'm gonna say C.
Bam! All net. That's how you're supposed to drive. That's it. Answer is C. Obtaining a client's written consent for a replacement. That's what you're supposed to do. That's what they're doing when they sign the application. Love it. Great job. All right, family. This is a pretty challenging test, but when you're learning this stuff, repetition is undefeated. If you listen to this over and over and over and over and over and write it down, it's not just reading it. If you read it, but you read it out, if you read it to yourself, there's one way. But if you read it out loud, you're hearing yourself. So you read it out loud, you're hearing it, and then you write it down. If you do that repetitively, ain't no way you won't pass the test the first try all day. Easy. I think people just don't do that. Their version of studying is just skimming over stuff. That's not studying. Studying is when you read it out loud, and you write it down several times every day for 2, 3, 4, 5 days in a row, and you'll have it. I promise, guaranteed.